Intermarket analysis and trading. How movements in bonds, currencies, stocks, and commodities relate to each other. Intermarket analysis is a powerful method used by traders and analysts to understand how different asset classes, bonds, currencies, stocks, and commodities interact with and influence each other. By studying these relationships, traders can anticipate trends, spot early warning signals, and make more informed decisions in a complex financial environment. 1. Understanding the core relationships. At the heart of intermarket analysis is the understanding that no market moves in isolation. Changes in one market often have a ripple effect on others. Here are some of the key relationships. Bonds versus stocks. Typically, bond prices and stock prices move inversely. Rising bond yields, falling bond prices, may signal inflation fears or tightening monetary policy, which can pressure stocks. Currencies versus commodities. Many commodities are priced in US dollars, so when the dollar strengthens, commodities like gold and oil often fall in price, and vice versa. Currency movements also impact export competitiveness, and thus stock markets. Commodities versus stocks. Rising commodity prices can hurt companies with high input costs, especially in manufacturing and transportation, leading to pressure on stock indices. Bonds versus commodities. Inflation expectations drive both markets. If investors expect inflation to rise, commodities, especially gold and oil, may increase, while bond prices may fall due to higher expected interest rates. Second, global examples in action. A rise in crude oil prices might boost energy stocks, but hurt airlines and transportation sectors. A strengthening Japanese yen typically pressures the Nikkei 225 due to the export-heavy nature of Japan's economy. When the Federal Reserve raises interest rates, U.S. bond yields rise, the dollar strengthens, and emerging market currencies and stocks often fall. 3. Using intermarket analysis and strategy, traders can use intermarket signals to confirm or challenge technical setups, identify shifts in risk appetite, anticipate macroeconomic turning points. Conclusion. By understanding how financial markets are interconnected, intermarket analysis allows traders to gain a broader view of market dynamics, spot hidden opportunities, and better manage risk across asset classes.